and a warm welcome to Tax Fine. I am your host, Laure Bala Hassan, and we've got a vibrant lineup for you today. We are kicking off this episode with the latest tax news. Then, in our Did You Know segment, we'll share some surprising tax facts that might just catch you off guard. Next is Vox Pop, where we hear your views on the streets. We'll unpack these views in the Knowledge Zone, giving you context and clarity. In Professional Insights, our experts break down the issues and offer practical guidance. And finally, in What's on the Net, we respond to your comments and questions from our social media handles. Let's dive right in. And now, the news. The chairman of the Presidential Committee on Fiscal Policy and Tax Reforms, Taiwo Oyedele, has again clarified concerns over the proposed 5% fuel surcharge. In a post on X, Oyedele explained that the charge is not a new tax introduced by the Tinubu administration. He said it has existed since 2007 under the FEMA Act and was only restated in the Nigeria Tax Act 2025 to harmonize existing laws and ensure transparency. Aisha Abdulkader has that report.
Speaking at the session, Oyedele highlighted the complexity and fragmentation of the nation's tax system, describing it as long overdue for reform. The new legislation, he explained, aims to harmonize overlapping taxes, eliminate irrelevant levies, and simplify compliance.
If you open the constitution now, bicycle tax is there, wheelbarrow tax is inside, produce tax, TV and radio is inside. So what we have done is we prepared a harmonized tax bill where all of these levies will be harmonized into one or two max.
Oyedele stressed the importance of fairness, noting that Nigeria's tax to GDP ratio is less than 10%, far below Africa's average. Speaking further, Oyedele added that aligning Nigeria's tax policies with international standards will boost investors' confidence, stabilize revenue, and reduce corruption through digitalization.
So this personal income tax that we have in this new tax law exempt low-income earners, reduce income or tax on middle class, and increases it on the high-income earners, so we can have a fair society.
With the new tax laws, FIRS says it hopes to simplify compliance, ensure fairness, and strengthen Nigeria's revenue base for national development.
The Federal Inland Revenue Service has organized a one-day training on the new tax laws for State House correspondents in Abuja. At the event, the chairman of the Presidential Committee on Fiscal Policy and Tax Reforms, Taiwo Oyedele, alongside FIRS officials, emphasized the need for Nigeria's tax system to be overhauled. Ejura Etu Okmanachi has the reports.
He noted that the surcharge will not take effect automatically in January 2026, but only when the Minister of Finance issues a commencement order published in the official gazette.
Before you implement, you need a commencement order by the finance minister. Not only that, that commencement order must be published in the gazette. Why did we do that? So give transparency and to ensure that if we need to implement it, it's done in a responsible manner.
Oyedele also explained that the measure will not apply to household fuels like kerosene, LPG, or CNG, and is designed strictly to fund Nigeria's road infrastructure. Oyedele stressed that the dedicated fund will help fix the nation's road network, cut logistics costs, and improve safety.
Over 150 countries have taxes on fuel that they dedicate into fixing roads. When roads are good, we travel safer, we travel faster, the cost is less, maintenance of your vehicle is less.
He added that while subsidy savings provide some relief, they are not enough to meet Nigerians' massive infrastructure needs. In his words, the reforms are not about increasing the burden on Nigerians, but about harmonizing taxes, blocking leakages, and ensuring sustainable development.
And the Federal Inland Revenue Service is driving forward its digital reform agenda with the rollout of nationwide e-invoicing. As part of the plan, the service has approved eTransact International PLC as a certified provider on its platform, the Merchant Buyer Solution. Saama Chido reports.
For eTransact, this recognition builds on its earlier role in automating VAT and withholding tax reporting. The company says e-invoicing is more than compliance, it's a game changer for efficiency and trust in Nigerian tax system. According to FIRS, this system will introduce structured digital invoices across business and government transactions, helping to simplify tax processes, strengthen compliance, and improve transparency. The acting director of tax automation, Mike Adoga, explained that only providers with nationwide reach, security, and capacity were cleared, with the National Information Technology Development Agency ensuring robust data protection and cybersecurity. This latest move built on its earlier success under Tax Administration 2.0 and now set the stage for Tax Administration 3.0. Aimed at delivering a smarter digital-first tax system for Nigeria. With the e-invoicing rollout, the FIRS says it is keeping pace with global standards while tailoring solutions to meet Nigerians' needs.
And that's a wrap on the news. Let's join Mariam on the Vox Pop segment.
Hello and welcome to the segment. My name is Mariam Julia Dura. Today we'll be talking about double taxation. Want to know more about it? Come along with me. What is double taxation?
Beautiful question. Double taxation is one of the problems we face in the tax environment. It could be in form of domestic or international double taxation. Domestic in the sense that once an individual earns an income who has been taxed in one jurisdiction, maybe the federal has already taxed it and has been taxed again in the state, or one state has already taxed an income and another state again, state B, is taxing that same income. For international, I think that is even better in the sense that there are arrangements to relieve this double taxation. There is treaty agreement, but there are some instances of unilateral arrangements. In a new tax law that's coming up, there's a unilateral arrangement such that if your income is being taxed already in one jurisdiction, in as much as you can provide evidence, you have a relief.
Double taxation is a situation where the same income is taxed by two different tax jurisdictions.
Okay.
The same income suffers tax. For example, let's say in Nigeria, you get taxed on your income here, and then in the UK as well, you get taxed on the same income that is generated here.
Double taxation simply means where the same income is taxed by two different jurisdictions. For instance, you may have done a particular business, you generated some income or profit from that business, and then you have to, maybe the business was done in the UK, for instance, and then while you are in the UK, that income or profit is subjected to tax as in the UK, and you come back to Nigeria, and the same income or profit is still subject to tax. That's basically what double taxation entails.
So I want to find out from you what double taxation is and if there's a difference between double and multiple taxation.
Okay, actually, double taxation and multiple are quite different. So when you say double taxation, it means that something has happened twice in the same circumstance. So what it means is that you have earned an income has been taxed double in two different jurisdictions. While multiple taxation is when there are different taxes. There are different taxes. The first one is the same tax in two different places and the same income. But this one, there are different taxes across different levels of government. Maybe you tax the same person in Lagos. The same tax goes to another state, they tax them. So it might have ending different things, activities within those states, or even different bodies are collecting taxes.
Did you know Nigeria signed a new tax treaty with ECOWAS countries to eliminate double taxation in 2023? For more information, please visit www.firs.gov.ng.
Ashu Abe takes us on the Knowledge Zone.
Hello and welcome to Knowledge Zone, where we give more insights to conversations earlier heard on the streets. I remain your host, Ashu Abe. In this episode, we'll be talking about double taxation agreements. A tax treaty, also known as Double Tax Agreement (DTA) or Double Tax Avoidance Agreement (DTAA), is an agreement between two countries to avoid or mitigate double taxation. Such treaties may cover a range of taxes, including income tax, inheritance tax, value-added tax, or other taxes. Nigeria signed a new tax treaty with ECOWAS countries to eliminate double taxation on income, capital, and inheritance taxes. This comes through an order signed by the Minister of Finance on the 1st of May 2023. And in addition to the 16 double tax treaty agreements that Nigeria has in force. Effective from January 1st, 2024, the treaty applies to various taxes like personal income tax, company income tax, petroleum profit tax, capital gains, tertiary education tax, and the National Information Technology Development Levy. Over to you, Lore.
And now to our Professional Insight segment.
My name is Ekata John, the head of tax expenditure management. What we do is we try to manage the incentive that is being granted, tax incentive that is being granted by the federal government, and we try to manage by trying to evaluate the tax expenditures as a result of the tax incentive that have been granted, and to look at how the indicators are looking, whether is it okay, is the economy going in the right direction, or if the economy is not going into that right direction. So that's what we do. So we try to articulate that for the service and for the country in general. We are happy to say that for now, we've been able to prepare the report, and we have forwarded it to our superiors. If you go to the report, you will see that tax expenditure to our GDP ratio is about 1.5%, and that is very encouraging. And also, if you look at the details, the indicators in the tax expenditure report, you will see that for budgetary functions and for objective, because when you do an analysis like that, you look at what are the objectives of this incentive. So when you look at the indicators for the objective of the incentive that have been granted, you will see that investment carried the highest ratio, which means that the economy have been boosted in terms of investment. And if you look at for budgetary function, it also gives us that indicator that, okay, fine, it was geared for economic growth and all that. So if you look at the percentages or the ratios, as you may call it, you will see that, yes, the economy is going in the right direction, because a 1.5 TE to GDP is very encouraging as compared to other countries. If you also cross-reference the tax expenditure to revenue collection, you see that it's just about 27%. Now, people will want to shout a whole 27%, that is TE to revenue collection. But if you cross-reference it to the objective, which is investment, you see that investment is 87%. So if you trade off 27% to 80-something%, you can see that the economy is really coasting in the right direction. So the analysis and the indicators are giving us hope that the economy is going in the right direction. We used to say that reasons are reasons and excuses are excuses. I'm going to answer that question based on facts and what it is, not what people emotionally think it should be. Our road infrastructure tax credit is not a tax incentive component. And the reasons are simple, and that is, what is tax expenditure? It's simply revenue forgone. What is the road infrastructure tax credit scheme? It does not in any way fall under that space of revenue forgone, because this is an understanding. It's a scheme whereby a taxpayer uses some of his taxes that he's supposed to pay, I'm just using that in the loose sense, and construct road for government and pay the other percentage to government. So in essence, an assessment would have been raised against that taxpayer, but the scheme permits you to say, okay, use maybe 50% of what you would have paid to government and do roads, and then pay the other 50% to government. So if you look at that, government didn't forego that revenue, so it doesn't fall in that category. Now, some people will want to ask, what about the 2% uplift? Because that is another burning issue. That, okay, fine, that government normally give them 2% uplift. That 2% is not a tax expenditure component. And the answer is no. Why? When a taxpayer defaults in paying taxes, when you calculate his additional taxes, the law says that you should do what? Penalize that taxpayer and add interest. Now, the interest that is being calculated is always based on the NPR. Now, so if the NPR is like presently is about 27%, now the law says that you should add 5% to the NPR. So the taxpayers will pay 27 plus 5%, which is about 33%, for either paying late or defaulting. Now, so if a taxpayer is now using his money to construct road for government before the due date of filing, because that is what the scheme says, just like a motivation, just like time value of money, so government feels, okay, let's give them 2% uplift. So if you cross-reference 33% that a taxpayer will pay for paying late taxes and 2% that government will give you for paying for using your money to construct road before the due date of filing, you can see that that's a win-win for government. So that's why we say it's not a component at all. And that we have already done. We have done the presentation, and I've also informed the budget office, and they have accepted that it's not a tax expenditure, so they should expunge it from their line item. I first appreciate the executive chairman for always encouraging the tax expenditure management, in the sense that he's always giving us a listening ear and approving most of our suggestions. And one of those things now is he has magnanimously agreed that we should go to the zones now to go and carry out sensitization exercises. And that is one way we are trying to prepare for 2026. And what is that supposed to bring to the table? Because we find out that most of the tax administrators don't really appreciate and understand what is tax expenditure. So if you don't understand what something is, you wouldn't really know what kind of data to supply. So one of the ways we are preparing towards 2026 is for us to go around and kind of educate the tax administrators. Why? Because they say charity begins at home. Then after the tax administrators, the next leg is for us to start educating the taxpayers, because it's the taxpayers that do the filing in our tax format system. So we are very prepared with the encouragement of the management that come 2026, most of the incentive that have been granted that the taxpayers may not even be aware, we want to bring it to their knowledge. For example, agri sector, educational sector, and the health sector, they have been granted waivers. Now, if you're a taxpayer and if you're not even aware of this, you wouldn't even be able to use it. So that's what we are trying to do, and we are happy that the management is giving us that support. Yeah, positive, very positive. And I will just give you one scenario. The scenario has to do with investment allowance. Investment allowance is a component of tax expenditure. And now, in trying to prepare the tax expenditure report for 2024, we realized that there were some humongous figures for investment allowances. Now, if we didn't have so much knowledge of tax management, tax administration, we would have just picked the figures. Now, we knew that something was wrong. So we reached out to some of the directors that are in charge of this department, and we highlighted those areas and when we noticed it, we realized that there was a mix-up somewhere. Now, so we have kind of spearheaded that review aspect of it, and they have already started. And what would that bring? Additional assessment, because they were wrongly classified. And now, without tax expenditure, that wouldn't have come to bear, because it wouldn't have been noticed. Yeah, so that have always been helping to increase revenue collection. The moment we noticed that, because we are dealing with the raw figures, so we quickly highlight it, and we work hand in hand with the departments that are in that area, and that had always helped to increase revenue collection. So the most important challenge that we are having for now is data collation. It's not been seamless, it's not been easy, because of the decentralization of the management of tax incentive. It has not really been easy for us to get this data. And the automation have not also been, though we've been working with the automation department to see how far they can refine the tax promax and include tax incentive component. But for now, we are still using the hybrid system. So that had always been a big problem for us. We've been able to write the 2024 tax expenditure domestic report. It's a big success, because considering the big challenges that we had, so for us to, at the end, still bring it to, I think that was a very big one for us, and we're grateful for that.
Over to Swateku for what's on the net.
Good day and welcome to What's on the Net. My name is Joyce Wateku. At AI, Kunle J is asking, which salary range is exempted from income tax from 2026? I need a response, please. Under the new law that will take effect from January 2026, anyone earning 800,000 naira or less per year will no longer be taxed. At AY Still Day is asking, which of the tax laws are you amending this time? CITA or PITA? At AY Still Day, Nigeria's latest tax reforms introduced key changes to both corporate and personal income tax laws, aiming to ease compliance, encourage growth, and increase government revenue. For companies, the Companies Income Tax Act, CITA, now offers reduced rates, dropping from 30% to 25% by 2026, and exempt small businesses with turnover below 50 million naira. Tax procedures are also more standardized and transparent. For individuals, the Personal Income Tax Act, PITA, now exempts annual incomes up to 800,000 naira, introduces progressive tax rates, and offers rent relief of up to 500,000 naira. Over to you, Laurie.
Thank you, Swat, for that beautiful segment. And that's a wrap on this episode of Tax File. I hope you are living with new knowledge and a sharper understanding of the tax world. The conversation continues online. Follow us and join the discussion. Until next time, I am Laurie Bala Hassan. Stay curious, stay compliant, and keep watching Tax File. FIRS, simplifying tax, maximizing revenue.